Another important thing to remember in our financial reports is that it is based on estimates, judgments, and models rather than exact depictions. So this is more of a warning on our financial statement users that of course there has to be a margin of error. It is impossible to prepare timely information that does not use any estimate or judgment. For example, for our depreciable assets, we cannot for sure determine whether an asset can be used for 10 years or 8 years, 9 years. We have to make an assessment, an estimate as early as on the date of its acquisition, especially for assets that are going to be depreciated based on production capacity. So if we say that this asset or equipment can produce 10,000 units, that is not an exact science. The actual amount may not really be 10,000. But we have to determine those amounts as early as on the date of its acquisition. The point here is that financial statement users have to exercise some degree of caution. That we have to trade off 100% accuracy for the sake of developing or producing timely information. And lastly, that financial reports do not show the exit or liquidation value of the entity. There is an important assumption in accounting, which we call the going concern assumption. And this assumption tells us that we expect an entity to continue to operate in the foreseeable future, that we expect the entity to operate for an indefinite period of time. And if that is our assumption, if we expect entities to continue to operate as long as possible, then it would not be smart to present our financial reports, to present our resources and claims based on their current market prices. So as such, it would be more reliable to use historical cost at times, because historical cost tends to be more verifiable. So even if we use it after 5 years, 10 years, 15 years, those amounts would still continue to be relevant. Whereas if you use current market prices, then that valuation would only be relevant for that particular day or time. In the next period, definitely that valuation will no longer be relevant or useful. So more often than not, general purpose financial reports use historical cost because this information is more verifiable and more reliable, as this cannot be refuted. It is now up to entities to make allotments for depreciation, amortization, or other matters so as to reflect the decrease in the value of our assets. But definitely, to simplify everything I've just mentioned, our general purpose financial reports do not show the current value of a reporting entity. So again, this would serve as a warning on our financial statement users. So as far as questions are concerned, I will just choose 4 out of these 5 questions and I will just change it to make it into a false statement. So it's important that you remember these statements and to understand why they are as such, for you to easily answer multiple choice questions asking you whether a particular statement is true or false. So from the resources and claims that will be presented in the financial reports, the information that we can derive from them would be an entity's liquidity and solvency. So by studying the resources and claims of the entity, you would be able to identify whether a particular entity needs more financing. Of course, if you are a potential investor, if you are a potential provider of capital, you would not be very interested on entities that are sufficiently funded. You will only be diluting the earning capacity, and you would also be able to determine or make an assessment on at what cost should you extend such loan or capital to the entity. A well-funded entity definitely would not be willing to avail of capital at a very high price, while entities that are desperate for capital would definitely be more willing to pay for high interest or high returns on your capital. And from the resources and claims as well, you'd be able to decide, is it likely for this entity to obtain financing in the future? Of course, again, providers of capital will not be attracted to entities that have very low potential for growth, or for entities that have shown very little operational feasibility. And if you're a creditor, if you're a potential creditor, you'd also want to know the priorities and payment requirements of the entity. If you are a simple creditor without any security, then definitely you are going to be the last in priority. So you would want, if you are going to extend a loan, you would want to be the one that is number one in priority or security. So basically, these items need no further explanation as to why financial statement users are interested to know these matters. There are two possible sources for our economic resources and claims to change. Number one would be financial performance. And with this, we'll be able to make assessment on the returns of our investment. If the economic resources of the entity continue to grow, then that may be explained because of a good financial performance. If a if an entity is well performing, then definitely we expect its assets, its economic resources to grow or to increase. On the other hand, we do not expect a well-performing entity to accumulate lots and lots of liabilities or claims against it. In fact, we expect the entity to be able to pay off liabilities that are no longer essential for its operation. So if we observe that the claims against the entity is going down, then definitely that could be a sign for a good financial performance. If we see that the economic resources of the entity is growing, then that would again be a sign for good financial performance. However, please do not think that all increases to economic resources and all decreases to claims against the entity are the result of a good financial performance. Because an entity's economic resources may increase simply because additional capital was infused into the company. What if the entity borrowed additional funds? Then definitely there will be more resources at the disposal of the entity. And just because the liabilities or the claims against the entity decrease doesn't mean that it is a result of past financial performance. It may just be because the entity was forced to settle or pay out the liability. So you will have to consider the changes in your economic resources together with the changes in the claims against the entity for you to have a clear picture on the viability of the entity as a potential investment or whether or not you should continue to invest or be associated in the entity. Another important concept introduced in chapter 1 is your accrual accounting. This is very important because this is how financial statements should be prepared. We should observe accrual accounting. In accrual accounting, the effects of transactions and events are reflected in the period in which they occurred, regardless of whether cash was already received or cash was already paid. The common alternative to accrual accounting is our cash basis accounting, but comparing the two, accrual accounting is more reliable as a measure for financial performance, as a tool for making an assessment on the viability of an entity, because it will tell you everything that is relevant for a particular period. Even though cash was not collected this period, but it's possible that the entity was actually doing well, it's just that the collection will happen in the future period. It's possible that we have made very little disbursements for this year, but it's just that we have accumulated so much liability. In cash basis accounting, we only monitor our cash inflows and cash outflows. We do not monitor whether you were able to make earnings this year or you were able to suffer losses this year. The reason also that accrual accounting is more relevant is because information based on accrual accounting is more difficult to manipulate compared to cash basis accounting. Reports based on accrual accounting are a better basis for assessing the returns on the entity and its future financial performance. In addition, information on the entity's financial performance would tell us on the entity's operational efficiency, on how well it uses its assets, how well it settles its liabilities, and it also gives us an idea on the entity's past and future ability to generate cash flows. Of course, our financial reports would be based on past information, so it definitely can tell us on how we were able to generate cash flows in the past. But using the same past information, using the same historical information, we would be able to make an assessment, we would be able to make a prediction on how the entity would be able to generate cash flows. And also, the financial performance of the entity will also be a reflection on how it reacted to changes in the market. Especially now that we are expecting the pandemic to have an adverse effect on the market, our financial performance would tell us the strength of the entity against adverse market conditions. So it's possible that we may not be earning so much, but when compared to others, the operations of the entity is more resilient and therefore has more potential to withstand the expected economic crisis. Also, information on the entity's past cash flows based on the entity's financial performance would tell us how well the entity manages its cash. If the entity is having difficulty generating cash, even though the entity is doing well, then that would be a poor sign of cash management. Again, that would be a reflection on the performance of our management. But again, it's very important for us to remember the changes in our economic resources and claims against the entity are not only driven by the entity's financial performance. Assets and liabilities of an entity are also affected by the issuance of additional equity or debt instruments. So it's possible that the source of the increase in asset or increase in liability is the issuance of additional debt or equity instrument by the issuance of additional shares or as a result of additional loans or borrowings. But definitely, such information can tell us how well the entity manages its capital. So to summarize this portion of chapter 1, this tells us that information about an entity's financial performance would tell us about the entity's operational efficiency, would tell us about the entity's ability to generate cash flow both in the past and in the future, and it would also tell us the entity's resiliency to adverse market conditions. And from those information on past cash flows, we'll be able to make an assessment on the entity's cash management. And aside from financial performance, changes in our assets and liabilities may be caused by other transactions such as the issuance of additional debt or equity instruments. And from this information, we will be able to make an assessment on the entity's capital management. So that would be the end of chapter 1. Again, if you're only capable of remembering one thing out of the entire discussion, let it be the ability to remember who the primary users are. Again, the primary users are your existing and potential investors, lenders, and other creditors. The next portion of the video would be a short exercise, a true or false exercise, wherein you will have to identify whether the statements are true or false. You may pause the video for you to have sufficient time to answer the exercise. So if you're done answering the exercise, we will now check your answers. Statement 1. In case of conflict between the framework and a standard, the former shall prevail. By the way, you'd notice that the exercise includes concepts from the introduction on the framework, not just from chapter 1. Again, in case of conflict between the framework and a standard, the former shall prevail. This is false because between a framework and a standard, it shall be the standard that will prevail. Number 2. Changes in the framework will automatically lead to the amendment of an affected standard. This is false. Changes in the framework do not lead to automatic changes to the affected standard. 3. The primary users of financial information include creditors, management, regulators, and the public. Out of the 4 items mentioned here, only the creditor is a primary user. The rest are referred to as our other users. Number 4, general purpose financial reports provide all the information needed by the primary users. Number 4 is false. As mentioned earlier, it is simply impossible to achieve such type of information. Number 5, an entity may be solvent but illiquid at the same time. Number 5 is true. Solvency is having sufficient assets to pay all your existing liabilities, while being liquid is simply having sufficient amount of cash at any given period of time to pay off your currently maturing liabilities. So even if you have a lot of assets, your assets is twice as much as your liabilities, but if most of your assets are invested in long-term assets, if most of your assets are invested in land, in buildings, then it may be possible that you do not have sufficient cash to pay off your currently maturing liabilities. Number 6, financial reports are prepared under the cash basis of accounting. Again, this is false because financial reports are going to be prepared using the accrual basis of accounting. Number 7, only financial performance can cause changes to the economic resources and claims against an entity. This is also false because aside from financial performance, economic resources and claims against the entity may change as a result of other transactions, such as the issuance of additional equity or debt instruments. So hopefully you got all the questions right, and hopefully this video will help you in the future to answer your examinations. Thank you.